Accounting. Accounting is the recording of financial transactions plus storing, sorting, retrieving, summarizing, and presenting the information in various reports and analysis. Accounting is also a profession consisting of individuals having the formal education to carry out this task. Important accounting concept. Individuals in their daily life think in terms of cash while they are doing. People deposit their paychecks and monitor their checkbook's balance. A firm, however, does not measure how well it is doing by monitoring its cash balance. A firm monitors accounting statements that use the concept of matching revenues with expenses related to producing that revenue. Revenue, cash sales, and accounts receivable, credit or sales to be collected as cash in the future. And then matching expenses. Cash expenses, accounts payable, expenses that help produce revenues but remain unpaid go to this account. Cash expenditures already made and charged off as an expense over time to match revenue, depreciation, and bond discount. Financial statements. Financial statements represent a formal record of the financial activities of an entity. These are written reports that quantify the financial strength, performance, and liquidity of a company. Financial statements reflect the financial effects of business, transactions, and events on the entity. There are 4 types of financial statements. First, statement of financial position. Statement of financial position, also known as the balance sheet, represents the financial position of an entity at a given date. It is comprised of the following 3 elements. Assets, something a business owns or controls. Liabilities, something a business owes to someone. Equity, what the business owes to its owners. This represents the amount of capital that remains in the business after its assets are used to pay off its outstanding liabilities. Equity therefore represents the difference between the assets and liabilities. This is an example of a balance sheet. Income statement. Income statement, also known as the profit and loss statement, reports the company's financial performance in terms of net profit or loss over a specified period. Income statement is composed of the following 2 elements. Income, what business has earned over a period. Expense, the cost incurred by the business over a period. Net profit or loss is arrived by deducting expenses from income. This is an example of an income statement. Cash flow statement. Cash flow statement presents the movement in cash and bank balances over a period. The movement in cash flows is classified into the following segments. Operating activities represents the cash flow from primary activities of a business. Activities represents cash flow from the purchase and sale of assets other than inventories. Financing activities represents cash flow generated or spent on raising and repaying share capital and debt together with the payments of interest and dividends. This is an example of a cash flow statement. Statement of changes in equity. Statement of changes in equity, also known as the statement of retained earnings, details the movement in owner's equity over a period. The movement in owner's equity is derived from the following elements. Net profit or loss during the period as reported in the income statement, share capital issued or repaid during the period, dividend payments, gains or losses recognized directly in equity, effects of a change in accounting policy or correction of accounting error. Goods and services. Production control consists of a well-defined set of has its objective, the coordination of all the elements of productive process, men, machines, tools, and materials into a smoothly flowing whole, which results in the fabrication of products with a minimum interruption. There are steps in production control. Planning. Planning is the part of production control that determines which materials and work are needed in order to produce the products offered from the manufacturing division. Routing. Routing is the part of production control that determines which route or path the work will take through the factory and where and by whom the processing shall be done. This requires the production controller to know in detail how each machine operation or work process is performed. Scheduling. Scheduling involves the getting up of the timetables that will govern the movement of the work, which is subjected to the various fabricating processes. For this, the production controller has to understand the nature of work and workload capability of each department. Dispatching. Dispatching is the part of production control that releases final work orders to the operating departments. It is the step where work orders spell out which work is to be done and the amount of time estimated for its completion. Performance, follow-up, and control. Lastly, the production controller must verify assess the performance results. For this purpose, elaborate control boards are sometimes set up, utilizing various printed forms that show the progress of the work section-wise or department-wise and serve as indicators of satisfactory or unsatisfactory performance. Purchasing. Producers or manufacturers purchase raw materials to be fabricated into products that are needed in the market. These products may be purchased by industrial customers for further processing or by distributors for eventual sale to ultimate consumers. Purchasing as such is a major task of a businessman. These are the steps in purchasing. First, establishing specification and determining the need for goods. Next, investigating the supply market. Then, starting purchasing negotiations. Placing the order, then following up the order, and lastly, receiving the goods.